Hey everyone, my name is Jack, and this is my third update on my portfolio that I'm building in M1 Finance. I'm attempting to reach $100,000 in this portfolio, and it's a mix of income and growth stocks in addition to some broader ETFs. If you want to start this series from the very beginning, check out the video linked above, which goes over the basics of this brokerage and the portfolio itself. The platform I'm using is M1 Finance, which is my favorite brokerage platform out there. What's really cool about M1 Finance is that you can take any dividends you earn and automatically reinvest them into the underweighted sections of your portfolio. You set a target allocation at the beginning, and because M1 Finance allows you to use fractional shares, you can really fine-tune your portfolio. As an example, you don't have to buy a whole share of Amazon to own Amazon stock. Instead, you can buy a small portion of one share to maintain your portfolio allocation. And as you can see here, I only have a few $100 in Amazon holdings, much less than one share's value, but M1 Finance still lets me buy it, and it balances out to my portfolio's target. It's an especially useful feature, and you can get started with a very small amount of money because of that and still maintain diversification without having to use something like an ETF. But M1 does have ETFs as well, so that's always still an option. Anyways, let's take a look at my portfolio. The month of March was crazy, to say the least, and April has been pretty wacky thus far as well. My portfolio has bounced around a bunch, and I've added a good amount of cash in the meantime. Last week, the market stormed back up around 12%, and many more investors are becoming optimistic about the markets, despite the steady flow of bad news and economic data. I actually just did a video on Goldman Sachs' prediction from earlier this week that we've reached the bottom of the market and that they think the S&P 500 will grow by about 8% by year's end.
If saying it would only make it so.
That's a pretty bold prediction if you ask me, and you can actually check out that video linked above if you want to learn some more. But in general, Goldman Sachs thinks that because the market has already priced in its expectations that economic news and earnings reports will be really bad this spring and early summer, the market should not go down very much at all once those reports actually come in. This would help to explain why the market has gone up despite unemployment numbers also going up at the same time. Goldman Sachs pointed out that most bear markets actually hit their bottom before the worst of the economic news comes out. And this is because stocks are ultimately based on their future expected returns. If investors expect bad news, then stock prices will go down. Then when the bad news does come out, as long as the news was as bad or perhaps better than initially expected, then stock prices may even go up since uncertainty has been reduced. And uncertainty is one of the strongest driving factors of stock value. If investors are uncertain about stocks, they will price in the risk of future bad news. The same really goes for any type of investment. The real question to ask here is, do you think that we are under or overestimating the situation around the pandemic and its relation to the greater economy? Goldman Sachs seems to think that we're no longer underestimating the pandemic's impact on the economy. Many other investors have joined them, but many investors still are bearish and think that the pandemic, among other things, will get significantly worse than most people might expect. But ultimately, it's impossible to time the market, at least reliably. There are so many moving parts, and seemingly random news can trigger a spiral downwards or upwards for that matter. If you're going to invest, you should focus on what you think the stock market will do over the long run. This isn't to say that different opportunities don't present themselves in different markets, but in general, the market should go up over the long run. If you're really unsure or uneasy about investing in stocks right now, you could dollar cost average, where you invest a little bit in increments each week or month, no matter which way the market is going in the short run. Now, this might limit your upside, but it would also limit your downside risk too. There's quite a bit of buzz around dollar cost averaging, and I think some of it is a bit misleading. So check out my video on dollar cost averaging linked above. I think it's definitely a viable strategy, but it's not some sort of undefeatable strategy that will always net you the highest returns. I use it on occasion, but if you want to limit some risk, periodically investing into the market during a volatile time can definitely do that for you. But you're not going to hit those home runs because you're investing at all points of the market, whether it's down or up. So you're going to get a theoretically more stable return, partly because you're parking a lot of your money in cash or less volatile assets in the meantime. Now, for some stocks in my portfolio to watch out for, the financial sector is definitely vulnerable to the crisis, but many banks are already taking pretty big steps to combat it. JP Morgan Chase, for example, just had their earnings call yesterday and had their quarterly net income drastically reduced, but they've also shown that they're building a huge cash reserve to weather the coming storm. Most of the big banks appear to be in okay shape heading into the next quarter, though they are definitely going to see a sizable hit to revenue, especially from the loss of many new mortgage sales in the foreseeable future as they tighten requirements. Disney makes up a decently large portion of my portfolio, as do Tesla and Amazon. They're part of my New World Order fund that I have in here. Disney has seen a massive hit to its share price with having to close its parks and cruises for the foreseeable future and likely through much of the summer holiday season, though we'll see. I have bought a good amount of it over the past month since it was heavily discounted in my view, so we'll see how much it recovers this summer and beyond. Tesla is a bit of a wild card with highly irregular revenue due to the crisis, but still what I think is a very strong business model and definitely a very loyal fan base. They have performed quite well for me just by chance because of when I've bought them, but their share price tends to swing up and down pretty violently. They are definitely a longer term play for me though, so it would be nice to pick up some more at a discount if it swings back down in the coming weeks. To the contrary, Amazon has been very stable through the crisis given their online business model covering a lot of shopping that was formerly done inside stores. Since stores are closed, they're in an even better position than they already were before the crisis. I'd be curious to see if their share price actually drops when quarantines end or at least ease up, since at least some brick and mortar retail competition will also open back up. Otherwise, half of my portfolio still sits in broad ETFs, which have done mediocre, but not too bad since I started this portfolio back in February, which happened to be a terrible time to start it since that was the current peak of the market. So what am I doing through all this? Well, I've contributed a few thousand over the last month and did catch a good bit of the gains over the last couple of weeks. My plan, if the market goes down a lot again, which I still think is more likely than not between now and probably June, is going to be taking out a margin loan using M1 Borrow. I have a few hundred drawn there already since the interest rate is pretty low at 3.5% and it's freeing up my cash elsewhere. And this is important because I'm making offers on some properties in Indianapolis right now after having taken out a pretty massive draw on a HELOC that I have in my condo to avoid having the HELOC frozen amidst the worrisome credit environment. The interest rate on my HELOC is only 2.25% right now, so it really isn't that expensive to have money sitting there in the short term. The M1 margin loan would allow me to keep investing into this M1 portfolio without having to tie up the cash that I want to reserve for real estate. If I can't find a deal within a month or two, I'll keep shoveling over money into my M1 portfolio while stocks are still, in many cases, relatively cheap. Ultimately, this portfolio is meant to be for the long term. My investment horizon is many years, not months, and that's why this portfolio is very diversified, with much of it being in ETFs that track a particular index. But I still have some more speculative portions of the portfolio, like this fund that focuses mainly on companies working on vaccines, but that's a very small portion of this portfolio. If you want to use this portfolio as a base to start your own, as always, you can actually copy it in the description below directly into your M1 Finance account. If you don't already have an account, it's free to use and trades are commission free. I am an affiliate, so I might earn a bonus if you end up signing up for M1 Finance, but I would at least hope that you would check them out since I do think they have some pretty cool tools. Of course, I am not a financial advisor, so definitely do your own research before making any investment decision and make sure that you understand your priorities and your personal investment time horizon, as everyone's decision will not be the same and I can't make a decision for you. But I hope I can at least inspire people to start taking action and building their financial futures. Whether you use M1 Finance or not, I also wanted to remind you that you can get 3 free stocks to start or add to your portfolios when you sign up for free accounts on Webull and Robinhood. Check out my affiliate links in the description below to get yourself those stocks. You can sell those stocks right after getting them and close your accounts if you really want to. They're free stocks on free brokerages, so get your free money. Unfortunately, there isn't that same deal with M1 Finance, but M1 Finance has different tools than the other 2 brokerages. Now, I got $20 worth of stocks when I opened my Webull account, so you might as well try as well. And you apparently can get a stock worth up to $1,400 when you open your account with Webull, and one of up to nearly $200 with Robinhood. So definitely let me know what stocks you guys get so I know that this promotion is working well, and maybe you can sell them to add the proceeds to your M1 Finance account if that floats your boat. Well, that's all I got for today. If you like this video, definitely like it since it helps the channel out a lot. If you want to see more content on investing, the markets, real estate, and other personal finance topics, be sure to subscribe so you don't miss any new updates. I post new videos every single week and wouldn't want you guys to miss out. I post an update to this series every month on the 15th as well. But definitely let me know if you guys want to see something in particular in the comments below. And until next time, take care.